Insurers globally are one of the biggest investors in fixed income markets. Their asset allocation decisions can drive the technicals of many of the global fixed income sectors.
In the early 1990s, commercial real estate lending on Wall Street was in the doldrums. Banks were not lending as they once were. Billions of dollars of debt issued in the 1980s was coming due, and few professionals saw that that area of the market could be a place to grow and innovate. But Ethan Penner, then a young fixed-income professional with stints at Drexel and Morgan Stanley, saw a chance to initiate what would become a massive change for the industry. From Penner's work at Nomura, the commercial mortgage-backed securities market was born. The work of lending billions in what were at the time considered mega deals, then pooling those loans and selling off slices or tranches. That unique innovation has become a linchpin in modern real estate finance and fixed income markets as well. For that reason alone, Penner is regarded as one of the giants whose work led to the creation of an entirely new field. Much like Michael Milken at Drexel, Louis Ranieri at Salomon Brothers, Penner's time at Nomura changed modern public fixed income investing. My guest today worked with Penner as a young analyst, and she was present at the creation of the CMBS market, which today has such a dominant role in the securitized credit markets. Alyssa Irving is now head of financial reserves management here at Wellington, and we have a unique opportunity to talk to her about the evolution of commercial real estate lending and what she thinks are the drivers of change going forward. I'm Amar Reganti, fixed income strategist, and as of this month, the global insurance strategist for Wellington Management. Alyssa, welcome to the Investor Exchange. It's great to have you here.
Thank you. Thanks so much for having me.
So really quick, what is the financial reserves management business?
So the financial reserves management business is really another name for our insurance investing business here at Wellington. We realized after the global financial crisis that managing insurance portfolios is really different than managing for other clients. And so we built, back in 2010, we built a dedicated team of portfolio managers focused on investing for insurers. Today, the team manages about $165 billion on behalf of insurers.
And I'm going to just sort of throw out, as someone who's worked both in the insurance and non-insurance side of the business, why should non-insurance clients and investors care about what insurers do or think about, I guess?
Insurers globally are one of the biggest investors in fixed income markets. Their asset allocation decisions can drive the technicals of many of the global fixed income sectors.
All right, well, going back to Penner's world, what was the market like at the time? I mean, it seems like the Wild West in everything I read about it.
Well, it's exciting to be talking about it because it's not something I spend too much time thinking about. It's, if I go back to 1996, it was a very formative time in my career. So just trying to remember those days there are a lot of fond memories in terms of being right out of undergraduate and being dropped on Wall Street at a Japanese bank with a group of commercial real estate professionals who were really among the best and were incredibly innovative. So if I think back to what was happening, it was right after the savings and loan crisis, and the RTC had just been created in terms of these government-supported, essentially, CMBS.
Just to our listeners, the RTC was the Resolution Trust Corporation, which was formed by the government to help bail out assets effectively owned by savings and loan corporations.
Exactly. So those were sort of the first CMBS transactions that had ever been done. And I think the group that was hired at Nomura was really focused on creating similar bonds out of non-government guaranteed cash flows, which were the very first CMBS transactions that were brought to market. So I worked there in 1996 to 1998. They were doing, at the time, you mentioned mega deals. We had mega deals, which were kind of like today's SASB. And we had, I think they were just called D deals that were actual what's called today conduit. And it was a a large pool of diversified commercial mortgages that were sliced and diced.
Well, what I find incredible in my 25 years in fixed income is that so many individuals who had moved up in the world of securitization, and particularly in CMBS, had some connection or professionally with that team. And you see them sort of everywhere, just like the high yield professionals often came and started at Drexel somehow. Oh, and as one further explainer, Alyssa used a term called SASB, which is what means single asset, single borrower. It means the securitization of an individual property rather than a conduit deal, which is an amalgamation of many properties. Did I say that and do that right?
Yeah, that was
Okay.
perfect.
Okay.
That was absolutely perfect.
Okay, well, you were there, or present, I guess, at the creation. Where have things evolved to now? And even like post GFC, like what's the big changes you've seen to get us to where we are now?
Well, one really interesting thought about back then compared to now is there are so many similarities. This is not that well known, but Nomura at the time was also doing other types of loans. They weren't just originating commercial mortgage loans. And one of my responsibilities when I was there is trying to figure out ways to securitize other assets away from commercial mortgage loans. It was actually how I ended up finding my way from Nomura to Fitch, was because of some of the loans that had been done at the time, trying to figure out if we could create private ABS structures back in 1998.
Now the hot topic.
The hot topic. And so there's so many similarities to what was being done in the 90s to what's happening today. The evolution of CMBS is very long, so I'm not sure I could do the best job of every aspect of the details, but it's commercial real estate's boom bust, as we know. And so when you put a commercial mortgage loan into a discrete trust and there's a long life for a commercial mortgage loan, therefore a long life for the bond, the bonds can be highly cyclical, I guess, is what I was trying to say. And so we've seen tremendous growth in lending since 1996 for commercial mortgages, but we've seen changes in who the lenders are, really, and that's driven a lot of the composition of the commercial mortgage backed.
So the lenders once were banks, and they wanted to move things off balance sheet. The lenders now are...
Today, the lenders are specialty finance companies, and there's a lot of private credit lenders out there as well. And so the CMBS market historically was about moving assets off balance sheet into a structure and maybe in some cases a NIM realization, but there's been a lot of accounting and regulatory changes since 1996 that today we have risk retention within CMBS, and there's meant to be skin in the game and alignment along the way.
So the securitization itself isn't achieving kind of the balance sheet or regulatory relief that the banks wanted when they first started doing this. So then you have this private credit channel sort of stepping in. Is that the next big, is that the future? Like that a much larger portion of these securitizations is going to be derived from what I would call the non-bank lenders?
I think it has to be. I think it is already. I think it's just getting started. I guess what could change that is the current administration's plans around deregulation. And so, frankly, I'm surprised that there isn't more discussion around changes to Dodd-Frank or things that could be done on the regulation side that could make the banks and the securitization markets more competitive to private credit. But today, private credit is far more competitive as a lending.
Will it be to some degree the whale that swallows the fish, kind of? This giant pool of private credit becoming almost the standard way of lending into this market versus the publicly traded and available CMBS that I've grown up with across my lifetime and you as well?
I think it all comes down to execution.
Yeah.
And so if the trend that we see today, the amount of demand that is out there for private credit continues, then I think it absolutely could be. To me, it's sort of like, some people don't like this term, but securitization used to be the shadow banking market. And I think today, private credit is the shadow banking market.
Yeah, I don't know why people actually get upset about that term. It just means a less regulated credit channel because there's not the direct kind of prudential oversight that banks have.
And I would say the securitized market is now heavily regulated post-GFC, and so there needed to be this creation of a new way to lend
Yeah.
that's less regulated.
When I look at my relative value charts in my book, the one thing that's almost like sticks out like a thumb is the spreads on CMBS, even at sort of, the higher part of the stack. That kind of combined with the AAA bankruptcies we've seen, like I think the one at 1740 Broadway, a property in New York City, which was widely sort of publicized. Like, how do you view the valuation right now? Is it a place where you're sort of just selective deal by deal, or do you like the entire sector because it looks, at least topically, like the cheapest part of the credit markets? Like, where do you come out?
It does look cheap.
It does look cheap.
It does look cheap, but I would say there's a number of things going on there. So if we dissect it a little bit and talk about just the AAA part of the capital structure, and we think about conduit specifically, you have to break it out into seasoned collateral and newer vintage or new origination collateral. The biggest reason you're getting optically paid more, in my opinion, is for cash flow variability. So what historically we would have thought was a bulleted payment structure is not that bulleted, because it turns out that loans can be modified and extended, and that the special servicer can do what's in the best interest of ideally all bondholders, but really the first loss position, to make workouts, highest recovery value. And oftentimes that decision, when you start to have a seasoned bond, is to modify loans, and then your cash flows are not what you expected.
That's so different from corporate credit.
So different.
Like, that would probably trigger a selective default of some sort.
Exactly.
Yeah.
And here, this is one thing that really, really rubs me the wrong way about AAA CMBS.
Taking it personally.
is that there's no protections for senior investors in the structure or in the documents that allows for cash flows to be what was expected.
So, in a way, when you say cash flows as expected, like in other ABS deals, for example, if there's underperformance of the collateral, the AAA will actually get paid faster almost.
Exactly.
That pay down structure doesn't exist in the CMBS world. Is that's
a good
broadly
word,
correct?
yes.
I know deal by deal. Yeah. Okay. That's interesting.
And in SASB, it's another conundrum where typically you're buying a floating rate. They're not all floating rate, but it's a 2-year non-call, and then it has 5 1-year extension options. And so are you buying a 2-year, a 3-year, a 4-year? A 5-year?
Yeah, it's funny. You don't even own the option either.
You don't.
Someone else
The borrower does.
The borrower owns the option.
So I think you have to be paid extra for that cash flow variability, and then you also have to be paid for the complexity of the underwriting, of understanding what the cash flow variability could be.
Are you paid for the liquidity?
You should be. I mean, I think in theory we all think that structured finance or securitized in general carries an illiquidity premium and a complexity premium. I mean, I think that in some places you're not paid enough, and in others you're paid more than you need to be.
So given your comments on the growth of the private side of the market, the challenges to what would have been the traditional bank-sponsored securitizations, what does that end up like from a client-facing perspective? Like, is it that people will just gravitate toward privates, or are there people, in your experience, who need just only the publics, even though that market might be shrinking? Is there some blending? Is that sort of like the next iteration of how people get exposure?
I think so. I think it's a little bit of all of the above. And I think having the ability of a fiduciary to be able to make the decision on what looks more compelling from either a credit underwriting standpoint or a valuation standpoint is pretty compelling from my seat. So the reason I say that is if I think about myself trying to find the best value for clients, looking across both publics and privates, I can observe that there are cases where there's too much money chasing a private, and you may see an example of a bond on the private side trading inside of a public in a given type of structure, say a data center.
Okay, as an example.
As an example. But yeah, I think increasingly it would make sense to me that investors be able to look across the spectrum and think about it holistically.
The last question I wanted to ask you, which I guess is a little bit of a surprise question, because you brought it up initially, is that way back when you're looking at things coming out of the RTC and there were interesting securitizations that were taking place. And now I see esoteric, securitizations taking place. To people listening who aren't as familiar with the world, how esoteric can it get? Like, what can you securitize?
I mean, you can securitize anything with a cash flow. Esoteric ABS makes me smile because I do think back to those times where when I first started at Fitch in 1998, I mean, we were rating film securitizations,
Right.
and I can't name them because they were private, and I can't talk about but we were.
There was the famous Bowie bonds of
Yeah, but
yesteryear.
interestingly, Bowie bonds got a lot of press, but it actually carried a guarantee from the record company, so it was essentially a corporate.
Oh,
Later, there were several securitizations of music catalogs.
I didn't know that about the Bowie bonds.
A lot of people don't.
You
a lot
can
of people
think
don't.
those cash flows are timeless.
Yeah.
But yeah.
But there are heavy metal bands that sold their music catalogs. There were several Motown greats that sold their music catalogs. And yeah, I think increasingly royalties are well understood that they
Royalties
they're
like
cash
pharma,
flows.
intellectual property rights.
Anything.
Well, look, you satisfied question I had there because it's just really interesting. I wanted to thank you for taking the time away from a very busy schedule to talk with us. That was Alyssa Irving, Head of Financial Reserves Management here at Wellington Management, and this is the Investor Exchange.
Thanks so much for having me.
The Investor Exchange podcast is a production of Wellington Management. Our producers are Mark Murphy and Dana Wickstead. The show is recorded, mixed, and edited by Mark Murphy. Production support from Dave Crow and Rasa Surmont. Animation support from Rasa Surmont. You can listen to the Investor Exchange at wellington.com and at most podcast platforms. Thanks for listening.
All investing involves risk, including potential loss of principal. Past results are not a reliable indicator of future results. Forward-looking statements should not be considered as guarantees or predictions of future events. This material was current as of the publication date. Wellington assumes no duty to update the content in the event that the information changes. This commentary is provided for informational purposes only. It is not research that is required to be prepared in accordance with the legal requirements designed to promote the independence of investment research. It is not subject to any prohibition on dealing ahead of the dissemination of investment research. It should not be viewed as a current or past recommendation and is not intended to constitute investment advice or an offer to sell or the solicitation of an offer to purchase any securities. It does not take into account the investment objectives, financial situation, or needs of any particular person. Wellington Management does not provide legal, tax, or accounting advice. The views expressed are those of the speaker and may not reflect the views of others at Wellington. This recording may not be reproduced or distributed in whole or in part for any purpose without the express written consent of Wellington Management. Please refer to the disclosure section of this podcast for complete details.